Good morning. Thank you for joining us for today's coffee talk. I hope the new time did not cause any problems for anyone, but we appreciate it. I look forward to discussing and speaking with you today. My name is Sean O'Brien, the president of QwickAnalytics, and I'm pleased, as always, to be joined by Steve Huntington. Steve is director of analytics here at QwickAnalytics. And I'll let Steve go ahead and introduce himself. Steve.
Thank you, Sean. Good morning, everyone. Thanks for joining us again for another round of our monthly coffee talks. As I mentioned before, I've been working with Sean for about a decade now, taking my experience in working with community financial institutions and everything from strategic planning and evaluation to model building and maintenance and capital planning, and putting it into this newer, more interactive environment to bring you these types of tools that hopefully credit unions can find real good value in.
Thank you, Steve. We also are pleased to be joined today by David Ruffin. David joined us in 2019 to start up and develop our newest division here at QwickAnalytics called IntelliCredit. And David, I'll go ahead and let you introduce yourself.
Thank you, Sean. And Steve, it's a delight and honor to be with you. I've certainly followed you on these previous coffee talks and enjoyed them. So I've been delighted to be invited. I have a number of years in the credit risk management business, and maybe you could say the oldest guy leading the newest division of the QwickAnalytics family. But for those of you that may not know IntelliCredit, the big distinction between us and our sister division, QwickAnalytics, is their kind of energy source is public data. Ours at IntelliCredit is what we call non-public data of the credit unions, where we look at information from your idiosyncratic kind of loan portfolios. And then compare. We like to think rather than compete, we actually coordinate with each other and complement each other. And hopefully you'll get some value in some of the comments we'll share today.
Thank you, David. So just a reminder about our, kind of our format here. We want it certainly to be interactive and certainly invite your questions. Currently you're muted. Probably the most effective and easiest way to engage today is either through the Q&A or chat function. You can submit your questions there, and we will monitor those and address those during the presentation or after we make a few remarks just on some of the updates we want to share with you here today. Again, just as a reminder, kind of as a follow-up to that, really what we've tried to do with these coffee talks in many ways is create a user group for our community of credit unions utilizing the CECLSolver. We want to, as best we can, kind of crowdsource questions that you might be experiencing that may be similar or common to others. We want to be able to effectively communicate that to our users, give you an opportunity every month to bring up any challenges or questions you might have just around utilizing the tool. We're able to share additional pieces of anecdotal information that either we're gaining or gleaning from other credit unions as we're working with them, or just industry information regarding CECL or just best practices, et cetera. So we will continue to provide these and update these each month. And as we get closer to implementation, obviously some of the topics will change. But again, just wanting to let our users know we're here for you, and we'll continue to support you to make sure this transition to CECL can be as seamless and anxiety-free as possible. So at this point, I'm just going to have Steve just talk a little bit. Obviously last quarter we had a lot of changes to the call report. So I'll just have Steve here kind of give you an update on where things are, and just again, a brief overview of the tool. Steve?
Yeah, I'll try to be brief on these comments. As we know, we have a lot of our current users are very familiar with the format already, but just to introduce everybody to the tool who hasn't seen it online yet. The two things that are kind of most important about utilizing our tool is we're using the weighted average remaining maturity, or the WARM method for the most part, for short. And when you first log into our tool, because we're using data that's available in the public realm, your entire history of loan loss experience, past due experience, loan balance experience by segment is already preloaded into the system the first time you log in, and updated on a quarterly basis as everyone files the call reports. So that's certainly a time saver from that perspective. The other thing to realize is that the entire environment lives in the cloud. It's a very much an interactive tool and should be used as such. And what I mean by that is every time you change an assumption or an input anywhere within the tool, the entire tool recalculates pretty much instantaneously. And so it allows you to save a lot of time when you're building scenarios to see, you know, what changes or assumptions are really relevant to your situation and which ones are pretty irrelevant given the size, structure of your portfolio, or where you've had credit issues in the past or not had credit issues. We've seen people pour over data and painstakingly do certain calculations only to find out that even if they were way off, it would make absolutely no difference in their overall reserve because of their specific situation. So our tool kind of allows you to do it in a much more accelerated and interactive time frame. But again, we plug in some WARMs or weighted average remaining maturities, and then the tool really goes to work and takes care of a lot of a number crunching for us, helping us calculate historical lifetime loss experience at the credit union, and then compare that to peer group averages so that you have some guidance on your qualitative factor adjustments, and then straight through to what the final CECL calculations are, allowing you to split out any loans that you need to individually assess, allowing you to deal with unfunded commitments as a separate ACL calculation, and all while taking into account or utilizing your publicly available historical data and your peers as well. The next slide, Sean, is just a reminder of how you sort of manage the tool in the online environment where we built it. You can build scenarios as often as you want to. You can create as many different scenarios as you need. You can export as much or as little as you need, depending upon the audience. Obviously, if you're exporting it to give it to the board, they're just going to want a quick summary, whereas your auditor might want all the nitty gritty. So you have full control over that. And we also make sure that, you know, there's ample spots to take notes, because as you will hear from your auditors and examiners many times in the past, and certainly going forward under CECL, as important as your assumptions is your narrative and justification thereof, right? And so having spots administratively where you can make notes as you work through the tool, as you work through a scenario at the segment level as to, you know, what your reasoning for it was, not only helps you in your exam or your audit, but also reminds you next quarter what you were thinking last time around, you know, when you made certain assumptions and plugged in certain values. So we, as a best practice, we suggest heavily utilizing the note-taking feature, and that all gets exported with the tool whenever you print off or export a tool. The notes are organized as well. On the next slide, just a couple things to remind our users. In the last couple months, we've added some additional comparative financial analysis. Since we were already gathering all the call report data from credit unions around the country, we were getting lots and lots of requests for, hey, can we see some stuff that's, you know, not just the credit stuff, but can we just look at a basic financial analysis and, you know, of our performance or the performance of one of our competitors, a peer. And so we added into the tool at no additional charge, just for all of our users. You can now, if you go to the next screen, Sean, look at your data over time, or look at, for any credit union in the country, you can go and pull up all their basic historical profitability and overview and balance sheet and income statement data. And then on the next slide, you can also do that in sort of a filtering way. A lot of times people ask us on our CECL tool, hey, I know you're utilizing that, you know, we're in peer group 5 because we're, you know, NCUA peer group 5, which is 100 to 500 million in assets. Who are the other ones who are between 100 to 500 in our state? And so this is an easy tool that you can go, this is just all the credit unions in the United States. You can organize it by state or by region. You can click on any column of data you want and sort it or organize it by that or filter it by that. So you can get it's a great filtering tool just to see who else is around in your neck of the woods, in your peer group, and have different types of earnings and profitability and balance sheet structure. Sean?
Yeah, thanks, Steve. We got a question here. How do you handle loans purchased through an acquisition and purchase accounting rules? So I think there's really two parts to that question. So one is just how we would, kind of account for that in the tool. And that's certainly an area where you can add a loan pool down there. The specifics around the accounting for, loans through purchase accounting rules, probably are, detailed enough that we can discuss those offline. But I think the reporting piece of it is you could separate those out and treat those as a new pool. So, Wayne's certainly happy to, follow up with that discussion just around the purchase accounting rules. But just from a kind of a management or administrative in our tool, that's where we have the green button on the homepage to allow you. I think you can go back and I think you can see it in the screenshot down here in the green button. You can add loan pools. Steve or David, anything you want to add there?
Yeah. The first thing is if you wanted to strip out the balances that were previously acquired in your final calculations and deal with it separately, you can go to your current balance column and simply net out the acquired balances, and so that you have your sort of organic pools, and you do the calculations and your long-term loss expectations based on those. And then if the acquired loans are being accounted for, if there was a fair value adjustment at acquisition, and then that needs to be modified over time, they can be dealt with separately.
Great. Okay. All right, Steve, if you wanted to discuss any updates on the HTM.
Yeah, if you've been to previous coffee talks, we'd mentioned that we're adding a space within the tool just to manage the held to maturity securities piece of CECL. If it is even a piece for you, many of you credit unions on the call right now, it won't amount to a hill of beans of difference, because you probably don't have very much in your held to maturity securities portfolio that is truly at risk of loss. And John and David can talk a little bit more about what that means. But we have had people request that even though it's a relatively small piece of the puzzle for most, that they don't want to deal with it separately. They'd like it to be within the tool. So this tab that you see here in front of you will be available in the next couple of weeks, and it'll just show some historical balances on your securities portfolio, and leave you a space to plug in a couple pools of, if you have any pools of at-risk HTM securities, and plug those values in there.
Yeah, I think the kind of the stumbling block for a lot of us around securities is kind of the commingling, if you will, of the idea of interest rate risk versus credit risk, right? So regardless of the security that you have, but again, for most credit unions, your securities portfolio probably typically consists of either, CDs that you might have purchased through Quick Rate, government agencies, government treasuries, mortgage-backed securities that are government sponsored, perhaps municipals. But those, and while many of you might, if you have those today, might be experiencing or have unrealized losses, that is due to interest rate risk, not credit risk. And that's the distinction. So as interest rates move up, security values that you might have purchased historically go down in value. That is not credit risk. That is interest rate risk. CECL is around the credit risk of those. If you think there is a chance of default by the US government, that they're not going to make good on their bills, that's what we're accounting for here. So the other area where, again, it's a smaller percentage of credit unions, you might own some type of corporate debt obligation, or you might own something else that does potentially contain credit risk. But for the majority of credit unions, your securities portfolio, again, maintains interest rate risk, but not credit risk. And so we didn't address this initially. We have enough users now that it has become a topic that was asked to be included. So as Steve touched on, this is how we're going to address it. But I gotta believe 90 to 95% of you, there's really just no credit risk in your portfolio. So certainly happy to have further discussions on this, but that typically is the area of misunderstanding around CECL and the securities portfolio.
And again, if it's not something that really pertains to you, like many on the call, when you're running the tool, when you're saving scenarios, when you're exporting it, you don't have to export this part of it at all if it's all zeros for you. So whenever we make enhancements like this, where we add pieces, we make sure that if you are already utilizing the tool and like the way it is and don't want these additional pieces, that you won't have to necessarily deal with them or export them if they're irrelevant to your situation.
Perfect. Thank you, Steve. All right, so next up, another area that potentially, causes a little bit of stumbling for our users is just around, the level of detail necessary for prepayment assumptions. Again, this is a topic that we have, had ongoing discussions with you about. Steve has, in the midst of those discussions, been working on and researching, different areas where we might be able to provide some industry average or analysis that can assist. I think the distinction here to again remember is precision versus accuracy. Most importantly, when we're talking about prepayment assumptions, is the necessary thing is to have a reasonable assumption. So Steve's going to discuss some of the steps we're going to take to provide you with additional information to better make those reasonable assumptions. Steve?
Yeah, we get questions all the time about, if you're calculating your WARMs, your weighted average remaining maturities internally, then what should be used for some sort of prepayment assumptions, because doing an entire prepayment study on your portfolio historically is a much more data intensive task, and a lot of institutions just don't have the data or the resources to do these types of long-term prepayment speed type studies. And if you're not getting any assistance from your core ALM provider, which a lot of times, unfortunately, there's none to be had from that perspective, then we may be calculating the WARMs for you. And if you're one of our users who has us calculating the WARMs for you, you're going to get that the report that we send you is an Excel file, which still allows you to go in and change the prepayment assumptions. By default, in our Excel tool, we just have sort of a plug in there, a starting point, if you will, which is a very conservative 10%, for example, on prepayment rates across the board. But we get questions all the time for, hey, is there any good industry data that we can use for long-term average prepayment rates? Sort of, I would say I probably reached the end of the internet multiple times searching for good data that meets these, that can be helpful. And the best thing that I've found from a mortgage loan perspective actually comes from the Federal Housing Finance Agency, the FHFA. On their website, it's hard to find, but apparently they publish a prepayment monitoring report. It's something they publish on a quarterly basis. And we found a page from that which represents exactly kind of what we're looking for. We thought could be very helpful. Just annualized CPR, or conditional or constant prepayment rates, for all Fannie Freddie mortgages, average for all coupons and remaining terms. So a great kind of baseline long-term annual prepayment rate trend. If you go to the next slide, Sean, you'll see a snapshot. This is that chart I was referring to. It's on page 5 of that report. We showed the link in the previous page. As you can see, annual prepayment rates have been as low as almost, just 7%, and they've been as high as almost 40%, all within the last 5 years. And so the range is remarkable. And that range right there is all probably within your look back period. So and keep in mind, when you're making a prepayment assumption, even if you use really good historical loan level data and do all these calculations, spend all this time, that's still only half the game, because they're not asking you for a calculation of the past. They're asking you for your expectation of the future. And so looking at long-term trends is probably A, a lot easier, and B, more reasonable in its approach than just looking at a couple of years of your own history, in my opinion. So if you kind of took a long-term average here, I'd say it looks like somewhere in the 15 to 20% as a long-term average annual prepayment rate for mortgage-related loans. And we've seen anecdotally from a lot of the rating agencies that they're seeing numbers in the 20% range, or slightly above 20%. And but that's come down significantly from in the 30s or the mid 30s just last year. And obviously that's mostly due to the changing interest rate environment. But we thought this could be a really helpful starting point for a lot of our users, especially if you're doing warm calculations, or we're giving you unadjusted warm calculations, which are close to or above or exceeding 10 years. That's an excessively long warm, after taking into account prepayment. So the first thing I suggest to users, if they're getting really, really long warms in their calculations around that 10-year mark or plus, is to go and revisit those prepayment assumptions. And for mortgage loans, where you'd probably see some of the longest warms, if you're using in the 5 to 10% range as your prepayment assumption annually, just know you're being extremely conservative. And there's lots of room to probably increase that estimate that you can defend and justify. Any comments, David or Sean, on the mortgage before I go into some of the other loan types?
I was going to say, just as a reminder, I'm going to pull up our screen here. Let me sure I reshare this right. So as a reminder, for many of you, we may be calculating your warms, right? We use our calculator, our Excel-based calculator that's found on the bottom left of your summary page. There is a link to our warm calculator. With you're certainly welcome to use this. Again, we are calculating this number on behalf of a number of our credit unions. And I think the important thing to keep in mind is, regardless of, again, what the estimate is, just know that a larger prepayment estimate is going to lower the warm, as Steve touched on. Lowering this from 20% to 10% is going to increase the warm. So for any of you who are holding large portfolios of mortgages, as Steve touched on, having a reasonable long-term assumption of between 15 and 20% is more than appropriate, and will likely put your warm into something under 10 years, which is often the concern a lot of credit unions might have, is the length of the warm that they have initially around their mortgage portfolio. So I think those are really the two kind of practical things to keep in mind as you're thinking about prepayment assumptions. I'm going to pop this question up here. Can you aggregate balances by month instead of individually when calculating the warm?
I think that depends on the specific data points that we're talking about. If you're doing a warm calculation and you're talking about just what's the total balance of this segment of this bucket, right? What's the total GL balance? That you would have, the problem is you can't really do that because you need to get the maturity, the contractual maturity data for each loan in there. Right. So you could do it at the aggregate level, but then you would need, as a starting point, what you're actually trying to calculate in the end. You would need an average of those contractual maturities if you're taking an aggregate of all the loans. And the average of the maturities is actually what we're trying to calculate here. So it may just be that in your data or in your report you're getting from your core or your ALM, they already have an average of the maturity dates, in which case, there you go. You just need to have a prepayment assumption built on top of that, and you're in good shape. So I think that's a question that we'd want to go offline and kind of have a one-on-one with you and take a look at what you're looking at. And then we could come up with the best approach to the easiest approach to get an appropriate warm calculation.
And so the follow-up question, Steve, was, can you aggregate by maturity month? And there again, you probably could get something. It's not going to be as good as the individual loans, but I know, for instance, I did do a kind of a simple analysis of this for an institution on the bank side, who actually, the call report has that information kind of by maturities, and it gets you close. So again, as Steve said, we can probably discuss it online. It's probably not ideal, but I think you probably could get there by aggregating by maturity months.
And I think it brings up a very good point here with these conversations about data is everybody is limited. We're all limited by the data that exists in the universe, right? So you can't do something more detailed if you simply don't have the data to do it. That's what drove a lot of community institutions to the warm method, to a portfolio-based approach in the first place, is that they looked and they said, we don't have 8 years of this type of loan level data with different vintages to do the type of analysis that some of the more complex methodologies require as a starting point. And even if we did, we don't have the resources to manage that data. And so, that had people, looking around back in 2019 and 2020, searching for a solution that used the data that they actually had. And so the warm method gets you to where you need to go with utilizing much more straightforward data sources.
Yeah, Steve, that's a great point, right? As I have been participating in a number of conferences speaking on CECL, and there have been regulator panels, that has been kind of the continual, refrain from the regulators, as Steve touched on, is two things. One, that smaller institutions don't need complex models when it comes to calculating CECL. Secondly, you're obviously constrained to the data you have available to you. So again, as Steve touched on, you can't do CECL for data you don't have or doesn't potentially exist. And third, I would say increasingly, we knew this at the beginning of the year, but the warm methodology is, increasingly becoming the methodology of choice for the industry, particularly for institutions under $1 billion. And I think a large part of that is twofold. One, obviously, there's somewhat of a familiarity to the process, that resembles the ALLL. But secondly, and probably more importantly, it is the most probably compatible methodology to utilize the call report information and complement information around your individual portfolios. So again, I think from our point of view and your point of view, these are all positive trends. But I think it's increasingly evident that the warm is the most popular methodology being utilized by.
And I want to finish the conversation about prepayments, but then afterwards, I think we're going to, David is going to talk to specifically more about that point, Sean. What happens when you need, quote, more than the warm? What happens if you get to a size where additional focus on a specific segment of your portfolio at the loan level becomes more, it's requirement. If your auditor or an examiner tells you it's a requirement, then it becomes a requirement, right? If the credit environment continues to deteriorate and you have a segment of your portfolio that is large from a risk from a capital standpoint, and you need additional focus, David's going to talk about exactly how we get there. Does it mean you have to scrap your approach with the warm portfolio method and start with an entirely new model for CECL? No, it absolutely does not. And that's something we wanted to solve for that David's going to talk about. But just circling back really quickly to finish the conversation about prepayment speeds, getting some additional guidance. So that was mortgage related. What about all your other loans? So the best thing that we have found to date, which gives some sort of guidance, comes from the good old Federal Reserve, the Term Asset-Backed Securities Loan Facility, the TALF, right? It's somewhat dated now, but they have actually, it's not from back in 2011. They've continued to update their standards and expectations up until about a year and a half ago. So this data is was updated in December of 2020. So not too bad. There's a link there where you can see what some of this data is, but it was some of the prepayment assumptions that the Fed used in that lending facility, which we thought pretty good idea as a good guidance. Now, everyone should keep in mind that CPRs stand for constant or conditional prepayment rates. They are an annualized value. So when you see a mortgage CPR of 10%, that's actually 10% a year. That's the number we want for our warm adjustment, right? When you see ABS, it actually stands for absolute prepayment speed, as opposed to, and it is not an annualized value. It's actually a monthly percentage of the original balance. And that's done mostly because a lot of these asset-backed loans, like auto loans, they have a much shorter, duration, right, than mortgage loans. And so you're focusing your prepayments as a percentage of the original balance. So you have to take that ABS and multiply it by 12 to annualize it. But long story short, long-term averages they see in for things like auto loans is a 1.5% ABS, which would mean about 18%, right? Annual prepayment rate. It's a little different depending upon whether it's a prime or a subprime or a motorcycle or RV type loan. They also have some guidance for equipment loans, and that's an annualized, that CPR is an annual rate, and then some other SBA type loans. So some good data in there that you can translate if it's an ABS into an annualized value and get some guidance on prepayment rates. But the general moral of the story here is if you're using a 5 to 10% annual prepayment rate assumption, you are being very conservative. And there is certainly room for you to increase that prepayment assumption to something more in the 15 to 20 to even 25% range. And that would have the effect of bringing the WARMs down. And all things being equal to most institutions, that would mean a smaller reserve requirement, right? CECL is all about estimating losses over the remaining life of the assets. Those losses accumulate until the assets mature. So the shorter your duration, the higher your prepayment assumption. In general, the smaller reserve you're going to need. So we thought this was going to be helpful industry data to provide, and we'll continue finding other sources and adding to this. But we thought it was a good starting point and time that we shared it.
And Steve, I might add that this is an example where the credit unions, I think, have an advantage, because much of this data you've already presented covers the bulk of the prototypical credit union portfolio. The banking side, in some cases where they've got a larger swaths of exposure to commercial loans, CRE, C&I, north of the small business, much of that data is considered proprietary by some of the valuation agencies, and it's not as open to the public research.
Thank you, David and Steve. That's great. Again, I think this is kind of, again, our ongoing commitment to try to, refine the tool and give you more resources. As Steve said, I think this, really supports the notion of a defendable prepayment assumption, which I think you can confidently utilize. And if there's challenges, make them push back on why it's not appropriate. Because again, this is as good of industry-wide data as you're going to find. So thank you for Steve for continuing to research this. As we touched on, and Steve, mentioned it just a minute ago, I think one question or one concern I think larger credit unions have had is just potentially around, as Steve said, do I need to do something at the loan level? So one of the reasons we asked David here today to join us is obviously in his 40 plus years of credit experience, he's seen a number of different reserve methodologies, but also can speak to the fact with the tools that we're building, how you can potentially supplement what we're doing with the portfolio solutions with loan level data. So David, do you want to just touch on a few of these credit concerns?
I do. I thank you, Sean. I want to make sure we're still talking CECL, right? And how does this relate to CECL? So I think that one of the things that's clear to me is the interest level in credit has remarkably changed in 5 months. I spoke at a CUNA conference in Tempe in January. And yes, it was acknowledged that it might still be out there. It was acknowledged that we have to do a little more loan review and this and that and the other. Well, I meant speaking to as this day or yesterday at a conference here in California. Well, just the energy level and temperature of the audience is palpable around concern about credit risk because of things that have transpired in the economy and all the interest rate increases and the rampant inflation. Long story short is we've got issues like, all that government largesse has left a legacy of all this inflation. That really has gotten over the fact they're getting blamed for missing the claim on inflation. And honestly, I think they're going to throw everything they've got at trying to use interest rates to wring part of it out. And that inevitably is going to have a factor on credit quality. It always does. I don't think we can believe the credit metrics will last as they sit today. Sean alluded to my long career. Well, I've never seen objective, current or recent historical credit metrics any more, pristine. But that's where IntelliCredit comes in. We like to think that the early detection of credit risk is really the link to your reducing losses. And that is the percolation of risk migration in the non-public sector. That's our specialty. Remember I said our energy source is your idiosyncratic loan data. That's where you begin to see telltale signs of stress and credit. Frankly, in all due respect to public data, it's not there. We like to say, to all reports, those horses are out of the barn. So in terms of managing credit risk, I think you're going to start needing to look at it. And we're huge advocates as we look at now the irony of where we sit today. We're now at the cusp of the third change in reserve methodology in my career. And there's going to be a lot of transition. There's going to be a lot of regulatory getting to know it just as much as it is our banks and credit unions getting to know the methodology. And there, in our belief, is rather than treat portfolio level and loan level as polar opposites or somehow one or the other, you've got to choose one or the other. We'd like to think you should look at complementing. Everything Steve and Sean have alluded to today is that the warm method, what's embedded, what's wrapped all around the CECLSolver is perfectly adequate for the great majority of certainly our customer base, which are community financial institutions. But there will be, and probably unfortunately in a growing sense, in the next year or two, more focus on a need to start identifying what segments of your portfolio are beginning to show stress. Remember, last financial crisis, we had almost a total focus on one industry, everything around 1 to 4 family residential mortgages. Unfortunately, now we're looking at a whole, labyrinth of potential industries that are struggling or even doing better because of the pandemic and because of the digitization of the marketing and all the things that are changing as we speak. And now we've had the economic shocks. So we've got a lot to deal with from a macro standpoint. There may be legitimate issues to come in and say, rather than just go wholesale. I love the fact that Steve just alluded to the fact, don't make a choice of one or the other. Look at them as complementary. And the way we're suggesting use of loan level focus now are things like get your loan review vendor to consider doing a stress test on select parts of your portfolio. That's what we did. And we think that's a good way of looking at loan level to complement a more broader portfolio level that seems to be perfectly adequate for the great majority of community banks. I will end by saying that a lot of two things, a lot of infrastructure support, administrative oversight of credit risk seems to be under a lot of stress right now because of salary inflation. A lot of financial institutions are having difficulty recruiting and retaining that kind of backshop talent to oversee credit risk. Now may be the worst time to be having to face that issue as well. And lastly, someone asked me a few months ago, what is your biggest fear? I said, my biggest single fear is overreaction. We've had such a long period of benign credit. All the stakeholders in our industry and what have you, and the regulators, of course, that included them, are used to very benign credit. I'm just worried that we're going to be looking at an overreaction, and that's going to require all financial institutions to be prepared to take a proactive stance on kind of writing your own script for understanding the unique credit risk that may be in place in your loan portfolios. Don't wait for a regulator to walk in with a proxy on what they think your risk level is. You have to be more proactive. We think we can complement that with some, and all institutions can, with some selective look at loan level data. So I hope you would see that as a complement, not as a competitor of broader portfolio level analysis.
Thanks, David. Just a reminder, again, IntelliCredit's really made up of a couple of solutions, as David touched on, right? There's just the traditional third-party loan review services that we provide, as well as cloud-based solutions for both internal review and a portfolio analyzer solution. Again, we think the portfolio analyzer can be, certainly a complement going forward, to monitor your own internal metrics, which certainly can be a energy source for future Q factors. Again, a reminder, we do, third-party loan reviews. We automate everything, so it makes for a much more efficient and affordable review. So if there's any interest or learning more about how you might be at stress testing to your loan reviews, that's something David and his team would certainly welcome the opportunity to discuss with you. Just a reminder, again, if you have any questions, to submit those through the Q&A or the chat. We will be coming back to you later this month with a demo of the CECLSolver in greater detail. That will be handled by Steve and Jason. So they will do a deeper dive. If you are new to CECL and QwickAnalytics and what we're doing here, with the CECLSolver, you can get a deeper look at it. We will be back again in August with another edition of Coffee Talk. Certainly as we enter the second half of this year, we know all of you will be diving into your data. So, we'll continue to try to address questions that come up in reviews of credit unions and their information. We'll talk more about just, anything at year end with adoption and just, evaluation of the reserve prior to, the measurement date. And then certainly we will continue to take feedback from you, our users, and continue to update our solution with any tweaks or improvements that we can get done, based on feedback from our, and our incredibly growing user, base. So, hey, Steve or David, any final comments or questions before we let everyone back to their day?
No, I would like to think that something that I got from leaders of financial institutions within the last 24 hours, talking to vendors, is we want value as well as tools. I would like you to think, just to say this, I'm very proud to be on a team that values that and makes that very much. Hopefully you'll see this as intangible evidence of that. We love to think that we offer a lot of substantive value and knowledge of what we're doing, wrapped around a lot of efficiency with the fintech. But hopefully we're hearing that a lot from people that run financial institutions. That's what they're wanting now. The market is really expecting or is purchasing value as much as they are a product these days. So I do think that's, hopefully you see that as our testament to you, frankly, that's what we're about.
Thank you, David. Steve, any final comments?
None come to mind right now.
Okay. All right. Well, on behalf of Steve and David, thank you all again for joining us. Thank you for working with us here at QwickRate. Certainly invite you to reach out to us with any questions that come up after we end here today, and then we'll look forward to seeing you again next month. So as always, thank you for your time. We appreciate it. And, we'll look forward to seeing you again next month and talking to you. Have a great day. Have a great weekend. Bye now.
Thanks, everybody.
Thank you.